Now we move into Learning Objective 10.6, where we explore the manufacturing overhead variances. The manufacturing overhead variance is the difference between actual overhead costs and standard overhead costs. Overhead is split into the variable overhead variance and the fixed overhead variance. The overhead variances are affected by production volume and resource usage. The variable manufacturing overhead variance is computed by using the hours of production time, for example, machine or labor hours. That is multiplied times the variable overhead rate per hour. Unfavorable variable overhead variance indicates higher costs for variable overhead items, or more direct labor hours or machine hours incurred than expected. A favorable variance indicates lower costs for variable overhead items or fewer hours incurred than expected. Here's an example. With the Bob Willis Custom Wheel Company, they incurred actual direct labor hours of 4,000 and standard direct labor hours of 3,750 hours. The variable overhead costs are the actual cost of 4,000 hours times a variable overhead rate of $11.25. That's compared to standard variable overhead, which is based off of an expected number of hours of 3,750 hours times a standard or expected variable overhead rate of $11 and approximately 67 cents per hour. This results in a total variance of $1,250, which is unfavorable because the actual variable overhead is higher than the standard. What's the root cause? Well, we can compute and analyze variable overhead variances much like we did with labor variances, using this three-column approach, where the left column, or column 1, and column 2 are compared to find the variable overhead rate variance. In this case, we isolate the hours of the cost driver, where in this case labor hours, and multiply that times the actual number of wheels produced. We let the rate vary between $11.25 and $11 and approximately 67 cents. You can see the difference between those two columns amounts to $1,670. This is the variable overhead rate variance. That difference is favorable because our actual rate is less than our standard. Now compare columns 2 and 3. In 2 and 3, we isolate the rate, holding it constant at $11.667. We then let the hours vary. In this case, the hours per unit of 0.8 hours versus 0.75, and we multiply that times the number of wheels produced, 5,000. We can see that the total difference between these two columns is $2,920. That difference is the overhead efficiency variance. In this case, the actual hours is greater than the standard. 0.8 hours is greater than 0.75. So that efficiency variance is unfavorable. We are less efficient. Taken together, we have a favorable overhead rate variance, but an unfavorable efficiency variance. Our total overhead variance is $1,250, and that is unfavorable. The variable overhead rate variance measures the difference between actual and standard overhead costs per hour. The variable overhead efficiency variance measures whether the company used more or fewer hours than expected. Root causes include changes in supply costs, electricity costs, repairs, or inefficiencies in production. Now complete Learning Activity 10.6. More expected 2,500 hair bands but produced 2,400. Compute the variable overhead rate variance, the variable overhead efficiency variance, and the total variable overhead variance. Use the two-column approach and indicate favorable or unfavorable. Pause your video here. Once you're finished, compare your answers with the solutions provided in the back of Chapter 10. Now we move into the fixed manufacturing overhead variance. The fixed overhead variance measures the difference between actual fixed overhead spending and budgeted fixed overhead spending. Fixed overhead costs includes things like rent, depreciation, and salaries. These costs do not vary with production volume in the short term. Fixed overhead can be broken down into components. Spending variance compares actual fixed overhead spending to budgeted fixed overhead spending. The efficiency variance reflects differences in labor or machine hours, whatever is used as the cost driver. Volume variance reflects differences between budgeted production volume and actual production volume, and it's often considered uncontrollable. The volume variance is often linked to sales volume rather than production efficiency. Now let's compare the fixed overhead variance. On the left side, we can see that there was 0.8 hours per wheel and we produced 5,000 wheels. Our fixed overhead cost per wheel is approximately $42. On the right-hand column, our standard hours were 0.75 hours per wheel, and again we produced 5,000 wheels. But our fixed overhead cost that was expected, or the standard fixed overhead cost on a per wheel basis, was $42.97 per wheel. The difference between the two columns is $6,862. And that's unfavorable because the actual fixed overhead cost of $168 is greater than the expected fixed overhead cost or standard fixed overhead of $161 and $138. Now let's analyze the fixed overhead variances, which is much more complicated. With the fixed overhead variances, we split them into three buckets: the fixed overhead spending variance, the fixed overhead efficiency variance, and the fixed overhead volume variance. Let's start with the spending variance, which is on the left-hand side, and comparing columns 1 and 2. In this case, we've now isolated hours. Setting the hours to the actual hours, that allows rate to change. So we can see that the effect of this variance is driven by the fixed overhead rate, or the amount we are spending on a per unit basis for various fixed overhead costs. In the second column, we're comparing our budget at our actual hours compared to our budget at the beginning of the year. That tells us if our hours are higher or we're using more time, and if we are more or less efficient. We've set the rate constant at $42.97 per hour. What we've allowed to change is the hours and the number of wheels produced. In this case, now we have more hours that we have consumed than we budgeted for. Since our actual hours are driving a higher cost, we have a negative or unfavorable fixed overhead efficiency variance. On the right-hand side is the fixed overhead volume variance. You can see that we've set the rate constant at $42.97 between columns 3 and in column 4. We also set the hours per unit constant at 0.75. That is the budgeted hours per unit. But we allow the number of wheels produced to change. The standard number of wheels or expected or budgeted wheels is 4,840 wheels. However, our actual was 5,000. So this cost difference is driven purely by production volume. We produced 5,000 wheels, which is greater than the expected volume of 4,840. That sounds favorable. We used more of our productive capacity than expected. However, that's uncontrollable if we are evaluating the production department, because the production quantity is driven by sales. We're not going to produce if we don't sell, and vice versa. So what's most important in evaluating fixed overhead is the fixed overhead spending variance. In this case, we spent less than we expected, and the fixed overhead efficiency variance. In this case, we were less efficient than expected. Let's go back and look at the root cause. The spending variance, again, is driven by actual versus standard overhead costs, controlled by production management. The efficiency variance is affected by differences in labor hours and reflects production efficiency as well. The volume variance, on the other hand, is caused by differences in budgeted versus actual production volume. This is commonly attributed to sales volume and uncontrollable if we are evaluating production management. Now let's complete learning activity 10.7. Compute the fixed overhead rate variance, fixed overhead efficiency variance, and fixed overhead volume variances along with the total fixed overhead variance. Use the three-column approach and label each variance as favorable or unfavorable. Pause your video here, and once you're finished, compare your answers with the solutions provided at the back of Chapter 10.